So welcome back to another session. If you haven't subscribed to our channel, ensure you do so. And remember to give this video a thumbs up. So today we'll be looking at inventory valuation. And you might ask, and we'll be looking at a few key points as per usual based on the topic. What is inventory valuation, or what is an inventory accounting system? And this is how costs are assigned to inventory. So essentially what we'll be doing is assessing and valuing the inventory we have. And by definition, you should know what, or my expectation is that you should know what inventory is. It is stock, right? It's what is selling that you've produced in the case of a manufacturer, or what you've purchased to resell in the case of a merchandiser. So there are two types of inventory systems. And the first one is the perpetual one, and the second one is the periodic. And the perpetual inventory system is one that records when stock is sold or received in real time. So this system automatically updates your selling and buying process of inventory. So at any given point in time, you should be able to have accurate and updated information about the inventory on hand using the perpetual inventory system. Continuing under the perpetual inventory system, there are different types, there are different methods to it. And the first one we have there is first in, first out. And this is just, again, it's under the perpetual inventory system, but it's just a method. So the perpetual system has three methods by which you go and value, by which you value your inventory. And the first one we have here, FIFO, we like to call it, stands for first in, first out. And what this means is that it looks at the selling part of your inventory. So what it's saying is that when you are selling your goods, you're using the first set of inventory that you have on hand. What that means is, okay, I purchased inventory today. I had some from before. So what I purchased is now added, right? That quantity is now added to what I had before. However, if tomorrow I am supposed to sell some goods, I have to sell from the first set that I had, which was the leftover. This helps with especially perishable items, right? So you're not just selling what you just buy, what you just purchased, but what has been there the longest. So that's what the first in, first out means. The first set of goods to go in is the first set of goods that goes out in the selling process. The next method is the LIFO, and that says last in, first out. So this is actually the opposite of the first in, first out, the FIFO. So what this is saying, the last set of goods that you acquire that goes in is the first set of goods that you sell, right? And the last method we have is the AVCO, the average cost or the weighted average. So how you sell goods, right? The cost that you value it at to sell it is based on an average cost of what you've had before, of the total that you've had before, plus what you purchased. So that's the perpetual inventory system. The periodic inventory system, I want you to tell me, drop it in the comments and tell me, what do you think the periodic inventory system is? An important concept that I want us to look at in terms of inventory valuation or inventory accounting system is the consistency concept, or the consistency principle. And what it suggests is that whatever method that you choose, so whether or not you're using the perpetual or the periodic, if you choose that method, stick to it. So if you're choosing the perpetual, which of the three methods are you going to use? Are you going to be using the FIFO? Are you going to be using the LIFO? Or are you going to be using the AVCO? Whichever method that you choose, stick to it. Not today or this month, we're using FIFO, and then the next 3 months using AVCO, then the next 2 months using LIFO. No, choose a method, stick with it, unless there's a good reason to switch. And the reason for this is that you must disclose the effect that this change will have on net income. And this change from either methods, if you're going to be using the FIFO, LIFO, or APCO, they have different effects on net income. So switching methods abruptly will severely affect the valuation of your inventory, the valuation of net income, and your assets overall. So that's what the consistency concept says. Choose a method, stick with it. So whichever method that you're choosing, stick with it. So those are just a few key points that I wanted to highlight before we go in to today's question. So today's question says, Hobart Sign Company began the month of June with an inventory of 50 signs that cost a total of $1,500. His purchases and sales on account were as follows. Two important things in this opening sentence that I want us to pay attention to. So he began the month with a certain amount of inventory. So that's what we're carrying over from a previous month, from a previous period, in this case, from the month before. So our beginning inventory is 50 signs that cost him. That's the price he paid for it, $1,500. The second thing that I want us to look at is the last sentence. It says, Hobart purchased and sold merchandise on accounts. So all we're seeing, everything that follows, the purchases and sales, these were on account, these were on credit. So it's going to be some form of able, right? Either accounts receivable in the case of a sale or accounts payable in the case of a purchase. So there you have those two key points that I wanted to bring across just from the opening sentence. Below, we're seeing, okay, different dates within the month of June where he purchased and he sold items, right? Next, it says Hobart uses the FIFO cost method. So we know, okay, first in, first out. So the first set of inventory on hand is what we're going to be selling first. Additionally, cash payments on account. So he made payments on account for things that he owed prior of $5,000. Okay. So there we're going to see, all right, we might need to do a journal entry for that. Okay. Operating expenses were $2,700. So this is an expense, all right. We can, depending on what it says, we can do a journal entry, but this will be shown in our income statement. Continuing on the same point, operating expense were $2,700. It says he paid 2/3 in cash and accrued the rest as accounts payable. So what this is saying, we find 2/3 of this 2,700, he paid that amount, right? And then the next portion of it, he owes it. He owes it, so that's that accounts payable. So here in our journal entry for this one, we're gonna have 3 accounts: the expense account, cash, and the remaining portion that was left unpaid, which is an accounts payable. Right? That's soaking a little bit. So what is required of us? Prepare a perpetual inventory record at FIFO cost for this merchandise. 2, make journal entries to record the company's transactions. And 3, prepare an income statement for the month ended June 30th. So we're going to be recording, doing the perpetual inventory system. So remember what the perpetual system is. After every transaction, it's something continuous. So it updates real time, whether or not you sold something or purchased something. So after each transaction, you're updating the system so you are aware of what you have on hand at any given time. For each of these transactions and other transactions that we're seeing here, we're supposed to do journal entries. Then we go ahead and prepare our income statement. So as per usual, we're going to be doing 1 and 2 simultaneously. So as we record in our perpetual inventory system, we're going to be doing the journal entries at the same time. So let's look at that. So what you're seeing here is our table that we rule up and we're starting. As per usual in accounting, whether or not or whenever you're doing an accounting statement, a financial statement, a table, you're doing up a T account, there's certain key items that must always be there. Can anyone remind me of those? Go ahead, put it in the comment section. Yes, so as always, you need to have the name of the company. With any statement or headings is important. So we start with the name of the company, and then below that we have what we're doing. And what we're doing here is the perpetual inventory record, in brackets, the FIFO method. The next thing that would usually follow is the date or the period. But in this case, you could put June there, but not necessarily, right? So when doing the perpetual inventory record, your table looks something like what you're seeing on your screen with the date. We always have the date. Then the first set of columns that you see there is for purchases. Under this column, below that you have quantity, unit cost, total cost. So what this is saying, okay, remember the perpetual inventory system, it's recording what? The purchase and sale of your goods, right? And knowing at any point in time what you have on hand. So inevitably, one of our columns is gonna include purchases. So here, and I believe this portion is self-explanatory. So what have you purchased? What's the quantity? What's the unit cost? What's the total cost? In any state, you might be given the total cost and the quantity. From there, you can find the unit cost. Or you might be given the quantity and the unit cost. From there, you should be able to find the total cost, right? The next set of columns speaks the cost of goods sold. And I'll say this column is in relation to what? The sale of a good. As the name suggests, the cost of the goods sold. And what this essentially is the cost, what it costs you to sell these goods, right? So under this column here, we have the same thing, quantity, unit cost, total cost. However, what I want us to pay key attention to is the cost, the dollar figures. So your quantity is gonna be equal to what you sell. However, how that is done is based on what it costs you, right? So depending on the method that you would have used, first in, first out, or last in, first out, or average cost, right? You'll be taking goods from your inventory based on the order or the method. So let's use an example, even though we'll further clarify this in our question to follow, right? So say you had one group of goods with 20, another with 15, another with 10, but you sold 25 sets of goods, right? What this is saying is we're using the first in, first out to sell 25 goods, right? You have it in order 20, one with 10, one with 15. To sell 25 goods using the first in, first out, I have to pick up that grouping with 10, give it, but I sold 25. So the next set that immediately follows that 20, I believe is the 10. So then I take 5 from that and I sell it. So our quantity won't be, oh, I sold 25, 25 is gonna be there. No, sometimes it's gonna be broken down. So that's for the quantity. Let's look at the unit cost. This is cost of goods sold. In your question, they will tell you that you sold it for such and such a figure. That is your selling price. That is not the cost. of your good. So that's not what it cost you to sell the good. What it cost you to sell the good is based on your purchasing price, right? So what gives you a full idea or a detailed idea of all the goods that you have on hand at any particular time is your inventory on hand column. So that's the cost that you'll be using there, right? And we know we multiply unit cost by quantity to get total cost. So let's look at the inventory on hand column. The same set of information, quantity, unit cost, total cost. So remember we say our perpetual system, right? At any point in time, it's something that's automatic. And at any point in time, you should be able to tell how or what quantity of goods you have on hand. So after each transaction, you have to update what is left. So if I sold from this, all right, so I have to subtract, put the remainder. If I purchased, what was there before with know what I have. So I hope that kind of gave you an idea of what we're going to be doing. So let's look a little bit deeper in the question and go through. So going back to the question, right? We know we started purchasing on June 3rd. However, we had what? This is a business that has been going on for some time. So it has what? Beginning inventory. And in this case, we began the month with 50 signs at a total cost, at a total of 1,500. So where is this going? We have our date, June 1, we began the month, right? And this is going to be going in our inventory on hand column, right? The quantity, 50. The total cost, the question gave us 1,500. So having both those information, we're able to find unit cost. What we did was what? To divide the 50 or quantity into our total cost, 1,500, and then got the 30. So now that we have our beginning inventory, let's look at the daily operations of the business. So on June 3rd, he purchased 60 signs at $35 each. So this is a purchase. Where is this going? Under a purchase column. So what we had before was 50 for 30 at 1,500. So the next one, June 3rd, under the purchase column, we have what? 60, and we purchased each at 35, so that's our unit cost. Multiplying those together, we have a total cost of 2,100. Again, after that transaction, we have to update what? Our inventory on hand. So we're seeing, okay, what we had before. We had 50 at a unit cost of 30, right? That gave us 1,500. And now they've purchased 60 at a unit cost of 35 for 2,100. And together that gives us a total cost of $3,600. Point to note, you're not going to be adding them and then put in 110. Why? Because they have separate unit costs. They didn't cost you the same amount of money. So you have to separate it, because when you're selling it, right, you're going to be valuing it at different costs. So this set of goods, it cost you $30. So you can sell it for a reduced price than the goods that cost you $35. So we'll be seeing how we go about separating and looking at it, having them separated. So this is for June 3rd. As we said, we're doing the journal entry simultaneously. So our journal entry again, any table that we're doing, form, statement, we have to have the name of the company. What are we doing? Journal entries. This is the heading for your journal entry. As per usual, we start with the date. So here is June 3rd. We purchased inventory, and this in blue that you're seeing here is a little narration. It's just telling what our journal entry is speaking about. So we purchased inventory. So it's a debit to inventory and a credit to accounts payable. A debit to inventory because inventory is an asset. You're purchasing, it's increasing. So that's a debit, 2,100. Credit accounts payable, a liability. When liability increases, we credit. So let's look at June 8th. On June 8th, we sold, there was a sale of 100 signs. And we sold this for $60 each. All right, so we sold 100 signs for $60. Looking back, our last transaction was June 3rd. Our inventory on hand, we have a set of 50, which cost us $30. We have a set of 60, which cost us $35. So we're doing what, using what? The FIFO method. So this is saying the first set of goods that we have in is the first set that we must sell. We sold 100. We don't have one set of goods with 100. And even if we did, that's not how we'd be going about doing our sale. So it's a sale, so we know we're going under where our cost of goods sold section. So we sold 100, right? The first in, first out, say, okay, we have to take from the first set of goods that we have. So we look over to our inventory on hand. The first set of goods that we have is 50. That cost us $30. So that's where we'll be taking first. That what we'll be giving out to him first. And this is how we get the quantity and the unit cost. So the quantity is 50 and the cost to sell it was 30. Yes, we sold it for 60. That's the selling price. That has nothing to do with this table here. Our selling price goes to our income statement, right? And we'll see that when we get to that part of the question. So the first set of goods that we have here, 50 at 30, but we sold 100. So what we need, 50 more. So what we're going to do, go to the next set that immediately follows. This is a set with 60 for $35. However, we only need 50. So what we're going to do is to take 50 from this set for the 35, right? So now if we're supposed to add this, the quantity here, we would have gotten the 100 that we sold him. This is the cost, what it cost us to sell him, the cost of the goods sold. But we sold him it at $60 each, which would be $6,000. So just from here, you can know that you made a profit, right? So what we need to now do, we need to update our inventory on hand. So we only took 50 from this 60. So we're left with 10 at 35. And the total cost of that, multiplying the two, gives us 350. I'm going to allow that to soak in a little bit. Think about it. All right. And let's look at our journal entry. So here we can see we have the date June 8th, but what we'll notice that normally a journal entry is just two accounts, one debit, one credit. However, in the sale of a good, right? In the sale of a good using the perpetual system, let me add that. It is two sets of inventory. The first set, two sets of journal entries. The first set of entries looks at your cost of goods sold, that increasing, because every time you sell a goods, it costs you because you had to make it, right? So that's like an expense, right? So that increases, so that's debited. And every time you sell a good, your inventory, your finished goods inventory decreases. And we say inventory is an asset. When it increases, it is debited. So therefore, when it decreases, we have to credit. And here, ignore this additional zero. Here, the cost that it cost us is what goes there, the 3,250, right? The next side or the next portion of this journal entry speaks to the actual sale of the good. And this is where the cost that we sold it for 100 for $60 each, multiply that, or total sales revenue is 6,000. This is where this part of the transaction comes in. And from the beginning of the question, it told us purchases and sales were on account, right? In the case of sale, it's going to be accounts receivable. In the case of purchases, it's going to be accounts payable. So this is a sale. So it's on account, it's an accounts receivable. Accounts receivable is a what? Accounts receivable is an asset. And when asset increases, what do? We debit. So this is why we're debiting accounts receivable, $6,000. That is what we sold it for. And we're crediting sales revenue, $6,000. And the narration for this is sale of inventory on account. So let's look at June 18th, right? June 18th, we had a what? We had a purchase, 90 signs, and we purchased it for $40 each. Looking back, our inventory on hand, 1035, that gives us 350. So here, we'll be going to the purchase column. How much did we purchase? 90. Unit cost, 40. Total cost, 3,600. After each transaction, what do? We update our inventory on hand. What did we have before? 10. At 35, bring that down. Then we now add what we just purchased, right? 90 at $40 each. That gives us together 350, and 3,600 gives us $3,950. Let's look at the journal entry for this transaction. This is a purchase of inventory, and like June 3rd, it's gonna be the same thing, right? It's gonna be a debit to inventory and a credit to accounts payable, and our narration is a purchase of inventory on account. So let's look at June 28th. June 28th. So what happened on June 28th? On June 28th, we sold 70 signs at $70 each. So remember, this $70 each is what? Or selling price. This goes where? This goes in our income statement, right? So we know a sale. In our adding in our perpetual inventory record system, it will be going on the cost of goods sold, the cost to sell the goods, not or selling price, right? So let's look at how we'll be doing that. We're using what? The first in, first out. So we look back at our inventory on hand, and we realize that the first set of goods that we have is 10 for 35. Yes, we sold 70, but the first set that we're going to give out is this 10 at 35. But we now need what? 60 more. So what we're going to do is to take 60 from that set that we have with 90, the next set, right? We sum both 350 and the 60 times the 40. We get 2,750. And here, remember, using our inventory, our perpetual system, we have to update our inventory on hand. And we have taken just 60 from this 90. So we have a balance of 30 at the same unit cost, 40. And that gives us a total cost of 1,200, right? So again, the journal entry for this, similar to June 8th, 2 sets. We're debiting cost of goods sold, crediting inventory, 2,750, the cost to sell it. And the next set of entries we have is accounts receivable and sales revenue, right? And that is 4,900. Why? Because we sold 70 for $70 each. 70 times 70 gives us 4,900, right? And our narration here, sale of inventory on account. So they're seeing there is nothing else here that is showing us anything to do with our inventory. So we go ahead back to our system and we sum. We close it out for the end of June. So June has 30 days. So what we do, we come under our purchase columns, we add everything that we purchased so we know, okay, for this month we purchased 150, we sum our total cost. We do the same thing for our cost of goods sold, right? Total quantity, we add everything 170 and we would have summed our cost and we get 6,000. This cost of goods sold should be going somewhere else. Where? We'll see further on. But if you know at this point, you can drop it in the comments. Point to note is that our inventory on hand was already updated, right? Because the last set of goods that we took out here was 60. So we have 30 at 40, which is 1,200. So there is no summing to do for your inventory on hand, right? But the question is not yet finished, right? We would have prepared the inventory record and we made journal entries, but it was just for the inventory record. Other things happened here, right? He made cash payments and he had operating expense. We still need to journalize those transactions, right? So the first one, made cash payments on account. What this looks like, this is saying, okay, I had an accounts payable. I took some goods, but I didn't pay for it, right? So that would have credited accounts payable. But now I am paying for it. So now we have to debit accounts payable to show a reduction in it. How did we pay it? We paid it by cash. So our cash is decreasing. Cash is an asset. When our assets decrease, we credit. So that's how we have a debit here to accounts payable and a credit to cash. And our narration says payment on account. The next transaction, we had operating expenses, total operating expense, 2,700. Here we paid 2/3 in cash and the remaining 1/3 in accounts payable. So here operating expense or expenses are debited. However, the credit side, we're having 2/3 of 2,700 is 1,800, right? We're crediting cash because cash is going out. And the remaining 1/3, which is 900, right, is accounts payable. So in this case, our accounts payable here is increasing until we've paid it off. And our narration here is just to record operating expense. Narration doesn't have to be a long sentence or a paragraph. You just want to explain what you're doing in the journal entry. So we would have completed part 1 and 2. The last part of this question says, prepare an income statement, right, for the month ended June 30th. As per usual, any statement that you're doing in accounting, we have our heading, which involves the name of the company, the statement that you're doing, and this time we have a period. It's for the month of June. So our income statement, a basic income statement, looks something like this. The income statement shows your revenue, your expenses, and doing the math there, subtracting your expenses from your revenue, you have your profit, right? So this is our basic income statement. Sales revenue less cost of goods sold gives you your gross profit, then you less your operating expenses, and you get your net profit. So let's start from the top. What was our sales revenue? Remember in the question when I had said these sales figure, right? Where are they going? To our income statement. So this is where the sale on June 8th, 100 at 60, and the sale on June 29th, 70 at 70. That's when those figures become important for income statement, right? So the sale, 100 at 60 plus the 70 at $70, right? 6,000 plus 4,900 gives us our sales revenue of 10,900, right? So the next thing is our cost of goods sold. We need to subtract it. Where are we getting that figure from? That figure is coming from the perpetual inventory record system. And this is why we total it. So this total of 6,000, this is the total cost of goods sold that it costs you to make this revenue of 10,900. So we're subtracting this 6,000 because it's our cost of goods sold from our revenue to get a gross profit of 4,900. Then we're going to be subtracting our operating expense, and that was in the latter part of the question of 2,700. Even though we only paid 1,800, it doesn't matter. The total expense was 2,700. So subtracting that from our gross profit, we get our net profit to be 2,200. So that's the end of our question. We would have completed all the requirements. If you have any questions, as per usual, remember, you can drop it in our comment section. Remember to subscribe to our channel to help us grow. Share this video with anyone who you think might need it or if it's useful, and to give us a thumbs up if this video assisted you in any way. Remember, you can reach out to us via email or our Instagram handle. So until next time, we'll see you for another question.